Hello and welcome to the program. I am Bisi Adibaya. Coming up today, World Bank approves additional credit of $130 million for Ghana to cushion the effects of the COVID-19 pandemic. Zambia's External Bondholder Committee set to reject government's request for an interest payment holiday. Plus, Africa Development Bank postpones this year's Africa Investment Forum till 2021. Well, let's get the show started right away with intraday numbers coming from the markets we track in Africa, where the all-share index in Nigeria is still showing positive signs with a 0.09% increase at intraday. In South Africa, the GSE index was also 0.15% in the green. The EGX30 in Egypt was down 0.7%, while Kenya closed 0.83% positive on Tuesday. And in the Middle East, the markets were largely positive at intraday, with the Abu Dhabi index up 1.34% and the Dubai FM 0.78% positive. On the other hand, though, the Qatar index saw declines of 0.12%, while the Saudi index was flat. So now to Europe, where stocks were modestly higher this morning as hopes rise over a forthcoming coronavirus vaccine. Investors are also keeping tabs on the latest developments involving the tech world. But let's get more on this from Chelsea Dulani, who joins us from the Frankfurt Stock Exchange. Good afternoon, Chelsea. So we're seeing China now joining the backlash to big tech, announcing new antitrust legislation to rein in the power of tech giants like Alibaba and Tencent. How did the markets react to this?
It's been a major shock to markets, and we've seen the shares of some of these big Chinese tech companies get hit really hard over the past day since these measures were announced. Alibaba, for example, which also is reporting a record increase in sales on its Singles Day holiday, it has seen its share price fall about 10%. Tencent is down almost as much, and JD.com, another rival, is falling nearly 10% as well. So investors are clearly taking these comments from the Chinese government quite seriously, and what the Chinese government is saying is basically that this period where Chinese tech giants were basically given pretty much free rein to do what they wanted is coming to an end. The Chinese government wants to really crack down on these companies because they're very concerned about the power they have, the amount of data that they have control over, and the way that's really squeezing out rivals in the tech world. So the Chinese government is looking at a number of new regulatory powers. This could really impact the core of these companies' businesses. It could mean changes to the way they handle data, changes to their algorithm, or even in some cases a divestiture of some of their business assets or intellectual property.
Now, China isn't alone on this one, Chelsea. The EU has also announced new charges against Amazon for anti-competitive behavior. Walk us through the EU's allegations.
What the EU is alleging is actually not that dissimilar to the criticism that China is now putting out there of its own tech companies. The EU is very concerned about the role of Amazon in the e-commerce world. So, in particular, the EU is criticizing this role that Amazon plays as a dual player in the market. So it's both a technology platform where other companies go to sell their goods, and at the same time it's a rival to those companies selling because it has its own brand, the private label brand, where Amazon sells a number of different goods from socks to batteries to furniture. And what the EU is saying is that Amazon is using some of that data it gets from being the platform where other companies go to sell their goods to really benefit itself and to benefit its brand. So a theoretical example of this could be Amazon looking at the data from other sellers on its platform, starts to notice that a particular product is doing very well, and makes the advertising of its own products more prominent to really take advantage of that sales boom. So this, the EU is alleging, is really anti-competitive and breaks the rules. We will have to see how this plays out. These trials, these investigations investigations usually take a very long time, but for Amazon, this could be a big problem. The potential penalty could be up to 10% of its worldwide sales, and for Amazon, which makes hundreds of billions of dollars every year, that could be a pretty stiff penalty.
It all pans out. Meantime, Germany's top economic experts today released their latest forecast for Europe's largest economy. Now, where do economists see the German economy going as the country remains in a second lockdown to combat the rise in coronavirus cases?
There's obviously still a tremendous amount of uncertainty about the economic outlook, but what this Council of Experts is seeing now looks quite positive. So they have revised their forecast for 2020 GDP for Germany to a contraction of 5.1%. They had previously been looking at a much steeper contraction of about 6.5%. So they have become more optimistic. Part of that is because the German economy rebounded a lot more strongly than many economists had expected over the summer. Once lockdown measures were lifted, we did see in particular a very strong bounce back in the manufacturing industrial side of the German economy, and that helped to really push growth higher than people had expected. And now, of course, with these lockdown measures in place, that could quickly change. For now, it seems that the industrial side of the economy seems quite safe. These new lockdown measures shouldn't force any factories to really close down, but of course the services side of the economy, restaurants, bars, hotels, are going to get hit much harder. And of course Germany is a big exporter, so the outlook is going to depend a large part on how these lockdown measures and the coronavirus containment measures around the world impact the economies of other countries.
All right, Chelsea, thank you. We'll see you again tomorrow. Let's move on to Asia now, where stocks were mixed on Wednesday, with tech shares in the region monitored following overnight declines for the sector on Wall Street. In Japan, the Nikkei 225 rose 1.78%, while the Topix index also gained 1.66%. South Korea's Kospi added 1.35% to close at 2,485.87. Mainland Chinese stocks declined, with the Shanghai Composite shedding 0.53%, while the Shenzhen Component declined 1.952%. In Hong Kong, the Hang Seng Index dipped 0.28%, finishing its trading day at 26,226.98. And shares in Australia rose, with the S&P ASX 200 up 1.72% to close at 6,449.7. All right, now it's time to cross to our London studio, where Juliana Olayinka will be telling us what is driving the markets at intraday. Good afternoon, Juliana. So Downing Street is expected to announce the biggest overhaul of British takeover law in an attempt to prevent overseas companies from buying up sensitive UK assets. Any idea what some of the new measures will require?
Good afternoon, Bissy. Well, it's a massive story, and it's certainly going to affect anybody trying to invest in Britain, particularly in mergers and acquisitions. Basically, what is going to happen under this new legislation is that British MPs can stop or prevent a hostile takeover from hostile states. That's what the Business Secretary Alok Sharma has called them, namely Russia and China, but there could potentially be other suspected countries on the list. And this framework, which is going to be called the National Security and Investment Bill, is pretty similar. We see it in countries like America, Italy, France and Australia already. And basically what it means is if your company is turning over a certain amount of money, then before you can decide to do a takeover with this other company, the British government will be getting involved. And they're doing this because they realise in a post-Brexit Britain that Britain is going to be quite sensitive, and there are particular industries that they're putting their eyes on. This is communications, artificial intelligence, nuclear energy, and they just want to secure to make sure that people are not taking any sensitive information from Britain. You said it's an overhaul, and I believe that's exactly how the business world is seeing it, because before you only had to be turning over a certain amount of money. I believe it was annually about £70 million before the government would bat an eyelid. That's not the case now, and there are some concerns, especially from city law firms, that are saying that, this could delay some takeovers that are already in the works. This could prevent some people from investing in Britain. Already at the moment, some investment that should be coming into the capital and in Britain has been going into Europe. So there are concerns about that. But Business Secretary Alok Sharma maintains his stance that this is a great thing for Britain and that we are just sticking to alignment and the framework that we are already seeing with our allies across the world.
All right, now let's talk about Rolls-Royce saying that it can create 6,000 UK jobs within 5 years if the government backs its plans to build small nuclear reactors around the country. Is the government likely to agree with Rolls-Royce plans, bearing in mind the gloomy unemployment data we saw yesterday?
Yes, I do believe so. And it's not specifically Rolls-Royce. Rolls-Royce are leading this consortium, but there are other firms that are involved. And it does appear that the British government will agree to this because they already invested about £60 million in the project a couple of years ago. Now, I believe the consortium are asking for a further £271 million. But considering that they're promising 6,000 jobs by 2025, I believe by 2035, they're saying this could potentially be 34,000 jobs, and it will be really jobs for high-skilled manufacturers, something that is particularly lacking in this country at the moment. Yesterday, we had the unemployment figures, didn't we, showing that unemployment had risen to 4.8%. Over 750,000 people have lost their jobs during this coronavirus pandemic. So it's pretty difficult for the government to say no to such a project when the labour market is just on the brink, and we are expecting it to get much worse. As I said, Rolls-Royce, the aero engineering company, they are leading the consortium, and also for them this is considered a great boost to their momentum, because before they announced that they were asking for more money for this project, they did say that they would be cutting 9,000 jobs worldwide, and 2/3 of those jobs will be coming from the UK. So it's a great day for the labour market, and of course for Boris Johnson and the Conservative Party's levelling up message. That levelling up message was a message that they broadcast after their historic monumental election victory in December, where they broke down Labour's red wall in the north. And these new nuclear reactive plants will be predominantly manufactured in the Midlands and in the north of England. So win-win for the government.
Absolutely, Juliana. And just before you go, take us through the numbers at intraday.
Yes, the FTSE is in positive territory at intraday. It opened in positive territory at early trading. Very quiet corporate day here in the UK because it is the 11th of the 11th, which means it's Armistice Day. It's Remembrance Day in Britain and for members of the Commonwealth. And Britain today are remembering their war dead. So not much on the corporate news front, but positive territory for markets. The FTSE All Share is up 0.68%. The FTSE 100 is up by 0.64%. And the FTSE 250 is up by 0.58%. In currencies, the British pound down on the US dollar by 0.13%, up on the euro by 0.16%, and up on the Japanese yen by 0.08%. Worth mentioning, British Airways owner IAG still leading the pack. They've done pretty well since the announcement of that coronavirus vaccine. And intraday, their shares are up 6.1%. And the Holiday Inn owner Intercontinental Group, their shares are down 4%. They're the biggest faller on the FTSE 100 BISI.
Thank you, Juliana. Do enjoy the rest of your day.
Thank you.
All right, when we come back in just a moment, we'll be talking about COVID-19 and the Ghanaian economy. Do stay with us. Welcome back. The World Bank has approved an additional credit of $130 million from the International Development Association for the Ghanaian government to cushion the effects of the resurgence of the COVID-19 pandemic and to safely reopen its economy. A statement from the global lender says the project will boost government's efforts to prevent and contain the virus and to safely revive socio-economic activities in the country. The number of daily coronavirus infections in Ghana have jumped fivefold close, raising concerns about a possible second wave in the West African country. But this brings us to our conversation with the managing partner at Bespoke Business Consulting, Alabi John Kennedy, who will be talking about the implications of this for the economy. Good afternoon, Mr. John Kennedy. Thank you for joining us on the program. So you just heard it. The World Bank has just approved an additional credit of $130 million financing to support the government's effort to cushion the effects of the pandemic on the economy. But how far do you think this will go in reviving socioeconomic activities in the country?
Well, thank you very much for having me. This will really help in providing socioeconomic growth in the economy, basically in the health sector, because mainly the fund is to actually provide health services and health care for COVID-19 patients. But let me add this, that in April, $100 million was actually provided, and now $130 million is also provided, which means there will be a chance that the debt stock of Ghana will increase by $230. This is not good at all, even though it's going to help for the short period. But there's also a positive side to this. If this funds is actually spent within the Ghana economy, it will help drive down it will drive down the dollar to CD currency exchange. And secondly, it will also help to promote small and medium-scale enterprises if the funds actually spent within the Ghana economy.
Now, in his address on Sunday, President Nana Akufo-Addo mentioned some of the incentives that have been put in place to help businesses ease through the pandemic. Now, what's your assessment of the government's response so far to aid their recovery?
Well, it's actually laudable. People were happy because these measures were actually put in place at the height of the COVID-19 period around April this year, and it has actually extended it to December, which means the health sector actually encouraged to do more. And secondly, the small scale business, which had some people from the government, also continue to enjoy this flow of funds. Then the populace generally had free water. They had their free water and had a kind of concession on the rate of amount they pay on electricity. So this is actually a good thing for Ghana right now.
Now, when you look at recent data from the Bank of Ghana's Composite Index of Economic Activities, it shows that the economy is responding positively due to the robust interventions put in place by the government. Do you agree with this as well?
Well, basically, it's something that it's fine. But when you look at, it depends on how you look at the composite index. From the Bank of Ghana's point of view, they are looking at change in economic activities, while the Ghana Statistical Service, who had the mandate of churning out all these indexes, are looking at it from an economic growth point of view. And when you do, as an analyst, when you do a weighted average of this, you are looking at an average of around 2% growth before the end of the year. Because normally what the measures that were put in place would take effect later in the year or at the beginning of next year. So you are looking at around 2% growth rate at the end of the year.
Managing partner at Bespoke Business Consulting, Alabi John Kennedy, thank you for speaking with us on the program.
Thank you for having me.
Well, let's turn now to Zambia, where the External Bondholder Committee is set to reject the government's request for an interest payment holiday, putting the country on course to become the first African sovereign defaulter since the onset of the coronavirus pandemic. Sources say there is consensus among the committee to reject the proposal, with a voting deadline of Wednesday ahead of meetings with creditors on Friday. The committee's members hold about 40% of the Southern African nation's $3 billion of outstanding dollar bonds and at least 25% of each, enough to vote down the proposal. The African Development Bank has postponed this year's Africa Investment Forum till 2021 due to the surge in coronavirus cases in parts of Africa. The event was to be hosted in Johannesburg, South Africa this month. Although no specific date has been given, the AFDB says the three-day event will continue to curate new deals, track investments, and advance the financial closure of transactions and existing deals through innovative digital platforms. At the 2019 edition, a total of 57 deals valued at $67.7 billion were tabled for discussions, while 52 deals worth $40.1 billion secured investment interest. Meantime, preparations for the third South Africa Investment Conference are currently underway, with South Africa halfway to meeting its target of achieving 1.2 trillion rand in investments. This year's conference will focus primarily on ensuring the investment pledges made in 2018 and 2019 and planned projects are not derailed by the COVID-19 pandemic.
Third annual South Africa Investment Conference. The first two pledges had raised 664 billion rand in pledges, and South Africa's Minister for Trade, Industry and Competition, Ibrahim Patel, says this year's edition will not only push for more investment, but will also take stock of the progress in implementation.
Of course, COVID-19 has impacted on the investment climate and on economic performance, on global markets, and we now need to address that. So this conference is an opportunity to assess what progress we've made with getting that 664 billion rand from an idea in the mind of an investor.
In August, Minister Patel was elected as the chair of the ministerial body tasked with finalizing negotiations on the terms for the commencement of the preferential trade agreements under the Africa Continental Free Trade Area. We asked him what the priorities the ministerial body will be pushing for the heads of government to sign off on.
There are four critical priorities that we would want to raise with heads of state. The first is to fix a date for the start of trading. That date should be early in 2021 so that we are able to see the benefits progressively and incrementally coming to African countries with the start of trading. The second one is to finalize rules of origin in a number of products so that we are able to have value addition on the African continent. Third area is to identify a meaningful number of tariff lines. And the fourth and final one is an industrialization vision underpinning the start of trading.
This year's conference comes as countries around the world continue to battle the COVID-19 pandemic, with foreign direct investment FDIs projected to drop by 40%, according to the United Nations 2020 World Investment Report.
And I think the key here would be to emphasize the story of resilience and adaptation to COVID-19 and the opportunities that have been opened up by a new way of doing business, a new way of thinking about supply chains, and also future opportunities.
Economy and Labour analyst Bukani Mgoma says the best time to invest is when the economy is on its knees.
The fact that it is happening is actually given some hope, particularly to the domestic market, that the government is doing something towards making sure that at least, even if we realize half of that 650 billion rand commitment, it will contribute towards the government's reconstruction of the economy. So that's the only issue which I think might work in our favor in terms of the sentiments, that at a political level, something is happening. The government has not abandoned ship, because remember, the best time to invest is when your economy is on its knees. You cannot wait for the economy to stand up, then you start investing, because you're going to be overtaken by events.
The 2020 installment of the South Africa Annual Investment Conference will be held in Sandton, Johannesburg from the 17th to the 18th of November.
And that's where we end today's program. Thank you for watching. I'm Bisi Adebayo.